next we move on to our first topic, actuaries in microinsurance, not responsible or irresponsible. Is going to be presented by David Kirk. We share the same name and we are sitting together. David is a principal at Milliman, the world's largest independent actuarial firm. He advises insurers on product development and pricing, valuation, risk, and capital management across sub-Saharan Africa. He is statutory actuary and head of the risk control function to several insurers, and has both life and short-term practicing certificates. He is currently the chairperson of the Actuarial Society of South Africa's Microinsurance Committee. Please.
I wonder if there's a risk of too many Davids sitting together. We might need to just diversify ourselves and spread ourselves. Good morning, everybody. I'm going to be talking on a mix of a professional topic and a technical topic, and a mix of some elements that are very specific to South Africa and others that apply more generally. I may not talk for all that long, so hopefully there'll be lots of questions that you can be thinking of as we go along, particularly how some of what I'm talking about may be relevant for you. Potentially, especially as your regulatory environment changes as well. So, not responsible or irresponsible is the topic, and really, I'm not saying I have the answer to that question. It is actually a question specifically in microinsurance that our microinsurance committee has been debating, for several months. Where do the lines of responsibility lie for actuaries? So, in terms of doing the right things, in terms of making sure we look after our insurers and look after their solvency. Who's responsible for what, and where are actually responsible, even if maybe they don't think they are. So being part of, so one other point, so I mean, it was before my time, but I've heard stories from older actuaries within South Africa about original annual conventions in a hotel in South Africa with sort of 50 or 70 people in it. And a few decades later, we've got thousands of people in multiple sessions. And it really is one of the events that everybody looks forward to, getting to meet the other actuaries, chats, discuss professional issues, and socialize. So I really hope that, and hopefully I'll be back here as well in the future, really hope we get a chance to really grow this as well. So it's very, very exciting for me to be part of this. And being part of a profession is great. You get the social elements, you get standards. By having a professional qualification, you have certain reserved positions and can be good for your income. But along with that comes responsibility that we have for a very long time as an actuarial profession, and in fact before there even were actuarial professions, being labelled with a given responsibility for solvency, for responsibility for making decisions, for applying judgment, for looking after policyholders. And that sort of normative aspect, that really is a very important part of our roles. Responsibility versus accountability, I guess I was putting it up there because some people do distinguish between responsibility and accountability in terms of who's responsible for getting things done and who's ultimately held accountable. In this presentation, I really am combining those two things, and in fact, it may more be around accountability. I just want to keep those ideas in mind. So I mentioned the fact that actuaries have been involved before they even were professions. I recall reading that in Australia even, there were roles written into legislation saying that bonus declarations must be approved by actuaries or similar professionals even before there was an actuarial profession in the UK, which is one of the older professions around. So this responsibility has been handed to us for a long time. Back to 1743, which is a little bit before my time as well, the Scottish Ministers' Widows Fund was not regulated very thoroughly because actuaries were involved, and the feeling was that if actuaries are involved in doing the right thing, we don't want to come in and impose outside regulations. I think the world has moved on since then. I think regulatory oversight of actuaries' involvement is a good idea. But again, this idea that there's a little responsibility around is very long-standing. So that's a bit of an introduction. I'm now going to spend the next few slides talking a little bit about the specifics of microinsurance in South Africa, because microinsurance is a general term for many things, small policies of low-income people across particularly India, Southeast Asia and Africa. And in South Africa we've come to form a fairly specific technical definition for regulatory purposes. And although this has been going on for the better part of 5 or 6 years, it does look like we are going to have specific microinsurance regulations from January next year. The idea with microinsurance in South Africa is that you are only allowed to write risk products, no savings elements, no return of premiums, no cashback, no loyalty, just a pure risk product, and that you may not guarantee premium rates for longer than 1 year. And the idea behind some of that is to reduce the complexity, reduce the risk to the insurance company, so that the risk of insolvency is very much lower, and that the technical risks and the calculations around capital and reserving are a lot simpler. So the whole drive behind this is in fact to make things as simple as possible to reduce the risks to the insurer. There are also investment restrictions. On the premium rates, renewal beyond 12 months is expected and can happen automatically. So you can take out a policy that you expect to have for many, many years, but the insurer is not permitted to guarantee the premiums prolong beyond 1 year. On the investment side, the investment options are very, very much restricted to basically cash and cash-like instruments. And again, that is to remove risks around illiquidity or market fluctuations in those investments, although there is an idea that you could apply for greater investment freedom on excess assets. The benefit limits are in the region of $5,000 to $10,000 as the sum assured, depending on whether it is a general insurance or a life insurance type risk. And you are allowed to combine general insurance and life insurance risks together. So that's quite a change, a departure from regulations in many parts of the world. And there is the role of an actuarial technician and not an appointed actuary or not a statutory actuary. The actuarial technician doesn't even necessarily have to be qualified. You can be a qualified actuary, a fellow, which gives 3 years of experience, so not a very experienced actuary, or you can be an actuarial associate with 5 years of experience. And again, the idea is that hopefully you've created a product set that is very simple, very low risk for the insurer, and therefore to again try to drive down costs and provide more opportunities for more people to operate in this actual technician role than even allow the associates who aren't yet qualified. For very large microinsurers, you can have 1 million policyholders and still be a microinsurer. The regulator has reserved the ability to be able to appoint an appointed actuary if needed. And the capital and reserve requirements are very simple. It's absolutely formulaic, absolutely mechanical. There is a percentage of premiums. So it is not risk-based, but it is volume-based. The more business you have on books, the more capital you will hold. So it is one step above having just an absolute dollar amount of capital. What's important though is that the actuarial technician has no responsibility per the legislation for reserving, for capital, or solvency. So the actuarial technician's pure job is around pricing, sign off that these premium rates are adequate. We'll touch on that a little moment in a few slides. That really is kind of crucial. You see, we are talking about not responsible versus irresponsible. We have the regulations. The actuary, the actual technician, is not responsible for reserving, for capital, or solvency, rather than just pricing. So I think I've asked the question, why only 1 year, why only risk only, why the investment restrictions? This really is to try to have the product as simple as possible, trying to drive down costs, to provide better value for money for policyholders. Now, in South Africa, and I'll talk through a few other countries in a moment, currently the statutory actuary, the appointed actuary for life insurers, there's a wide range of responsibilities included both in our Long-Term Insurance Act and in our Actuarial Practice Note number 106. You, as a statutory actuary, you're responsible for solvency, making sure you've got a proper spread of assets, declaring dividends only if the company can report it, can afford it, ensuring that premiums and benefits are calculated sensibly and taking into account reasonable expectations, and yes, responsible for the evaluation of the capital and ultimately solvency. APN 106 is a guidance note issued by the Actuarial Society of South Africa that provides additional guidance and additional support And every time I read it, there are new things that I find there that actually is supposed to be responsible as statutory actuary. It really is quite wide-ranging. Short-term insurance at the moment is very different. The vast majority of our 70-odd short-term insurers or general insurers don't have a statutory actuary or an appointed actuary. Our regulator has told a few specific insurers that they are required to have an appointed actuary, where the regulator feels a little bit uncomfortable. So it is very encouraging to hear that in Zimbabwe there is, again, an increased role for actuaries in general insurance. We have our professional conduct standards and actuarial code that describes various other ethical and professional responsibilities that we have to abide by. The UK, they've changed their rules there a little bit. They've got actuarial function holders and with-profit actuaries and reviewing actuaries, but also through all of those responsible for treating customers fairly, making sure the right sort of products and sales process, responsible for solvency, risk management, capital requirements, discretion and declaration of bonuses, and ultimately advising the auditor whether the firm complies with reserving and capital requirements. So across all of these requirements, it's quite hard to find something that the actuary isn't responsible for in total. In Malaysia, valuation is the actuary's responsibility. Identifying risks and mitigating risks, very much a risk management role, is their responsibility. And again, surplus distribution and dividend distribution is within the scope of actuaries in Malaysia. New Zealand, again, responsible for solvency. In Jamaica, actual valuation, solvency, risk and capital management. In a discussion yesterday, I heard that in Kenya, the statutory actually signed off on a wider range of risks, including elements of internal audit. So again, in many areas, actually a very wide responsibility. But even in South Africa and in the UK with Solvency II, across Europe with Solvency II, some of these requirements are changing. The head of the risk control function is a new required role. In many ways, the risk control function will be very similar often to a chief risk officer or a head of risk, has wide responsibility for the overall risks across the insurer, and the head of actuarial control, which for all intents and purposes replaces our statutory actuary role, has a narrower level of responsibility than before. So even if we aren't talking solely on microinsurance, in South Africa there's again changes in the responsibility that actuaries have from a regulatory perspective. Another important change is that long-term and short-term insurers have more or less the same requirements. So again, that has led to increased involvement in actuaries in short-term insurance. I mean, so 10, 15 years ago, there was only a small handful of general insurance actuaries in South Africa. Now when we have the short-term insurance seminar, it's easy 200 or 250 short-term actuaries attending that. And that's been partly growing through industry recognizing the value that actuaries can have, and regulatory developments with more actuaries realizing that there needs to be involved in insurance. And then a lot of responsibilities of a SAM are actually pushed up to the board. You have the unique problem if you're a board member and you're an actuary, where your different levels of responsibility lie. Treating customers fairly, which is very, very wide-ranging, is ultimately the responsibility of the board. It's unquestionable that the actuary will have input into that, but ultimately the board is responsible. So we've been fortunate enough to have fairly few failures of insurers in South Africa. I saw a stat recently said that we've actually, in the last 21 years, we've had something like 18 bank failures in South Africa, which is a stat that even not many South Africans are aware of. It's a frighteningly large number of failures, and a very, very small number of insurer failures. And curiously to me, some people aren't even aware of those that are placed in a curatorship. It is not really given that much publicity, which is maybe a second worry. But when an insurer fails, who's to blame? And I mean, there are a wide range of people, but ultimately I think the board of directors does need to take significant responsibility, and that is being encoded even more under our new regulations. But many times the statutory actuary, I think, needs to take at least some share of that. There was one case of a failed insurance in South Africa where arguably the statutory actuary was felt to have been too weak and didn't push back, and the board was, and the management were making certain decisions around how to invest, what bonuses to declare, none of which were particularly prudent. And I think hopefully we would have liked the statutory actuary to have had a stronger view there. But even if you aren't the statutory actuary, what level of responsibility come from just being actually involved? Okay, so we don't want the actuary to be responsible. And ultimately, I think the regulator needs to at least recognize whether they need to take some blame as well. We'll probably talk about it later in our SAM panel discussion, but the more information the regulator has, the more difficult it is for the regulator to say we weren't aware, which is another challenge to think about. Okay, so just to reiterate, all the microinsurance actuarial technician is really responsible for is calculating the total premium. You need to look at the risk premium allowance for expenses, discounting, any reinsurance, and an appropriate profit margin. Whereas the board is responsible for solvency, treating customers fairly, and pretty much everything else. So responsibilities on the finance function, the risk functions, and the audit impact are very, very much higher. So that's the theory, and in theory you could say the actuary is not responsible for almost everything, and you could be happily signing off on premium rates, even knowing full well that the insurer is insolvent and doesn't have the cash available to pay claims. But you are not responsible for that, because the regulations say you only worry about pricing. And I hope you're all feeling very uncomfortable with that idea, because it really is a challenge to me to feel how you can be aware of this information and just do nothing about it. And in fact, it's not like you can even pretend not to be aware. In calculating, so the regulatory requirement for an IBNR is 7% of your premiums. There's nothing you can do to change that number, that is what you send to the regulator. But in doing your pricing, oftentimes you will need to work out your own view of the IBNR in order to have a proper view of the claims incurred over the period to accurately determine your past experience as an input into future pricing. So what happens if you do your calculations and you find out that actually, in fact, for your insurer, it isn't 7% of premiums, it's 15% of premiums. Do you factor it into your pricing and then ignore it everywhere else? You don't tell the board, you don't tell the regulator? And that's a scenario where you would need to have that information and what you do with it. Another example might be that while you're doing your pricing exercise, you recognize that your current premium rates are unprofitable. And you can change the prices, and maybe you've got a 3-month period before you can practically affect those premium changes. But now you've got at an absolute minimum 3 months where you know your premiums are not sufficient to cover the risk that you are insuring. There's no responsibility with the regulations for you to calculate a premium deficiency reserve or an additional unexpired risk reserve or anything like that, but you are aware that actually there's a shortfall in the balance sheet. Again, you're not responsible, but is that all you do about it? Similarly, and this really came up for discussion in our committee meeting a few weeks back, there could be some very good reasons for a company to decide in the short term we want to sell and we are happy to sell business that makes a loss. We've got more than enough capital base, we want to enter into a new market, we want to increase our scale so that in several years' time we're going to have a bigger, more profitable business. So for right now, we are happy to make a small loss on our business. So you as a microinsurance actuarial technician, you sign up to say that the rate must be $10, and maybe says, right, we're going to charge $8. But is that a problem? How do you deal with that sort of information? So many of those things, I think, are things that can be very reasonably expected that an actuary involved would know about, the analysis would have informed, but there's also a question of what might be unreasonably expected. Are you responsible for the sales practices? Are you responsible for what brokers tell clients at point of sale? Are you responsible for marketing material, which certainly me as actually I do pay attention to? Then it becomes a little bit more grey. Are you responsible for failing controls within the finance function? It has an impact on solvency. You might well not be aware of it, and it is absolutely not your legislated responsibility to worry about reserves and solvency and the finances. In fact, potentially with many microinsurers, they tend to be sometimes, not always, but slightly smaller organizations, slightly less well equipped in terms of other staff and other risk functions. They might have a board that is perhaps less involved with insurance. So by virtue of being involved with a microinsurer, could you potentially have a greater responsibility as an actuary working for an insurance company than a statutory actuary working at Small Mutual or First Mutual or a very large organization with multiple levels of governance and multiple levels of control and lots of different people looking at different issues. If you're the only actuarial person within that organization, can you just turn your back and say, not my problem, I'm not going to worry about it? So there's clearly a line somewhere, and it's a challenge that each of us might actually decide on a different line of where that responsibility lies, which is quite an awkward position. So certainly we're hoping to provide additional guidance to actuaries on what to do in these different situations. And this is just a starting point, a draft, a work in progress, some ideas, and I really would be very happy to get questions or agreement or disagreement on any of these points. Some of the things that we thought would be important. If you're an outside contractor or consultant, you should have a very, very clear engagement level contract which says, this is what you are doing, this is what you're not doing, this is what you're responsible, this is what you're not responsible for. If you're an employee, also understand in terms of your performance contract or your goals or whatever, that you understand this is what is actually in and out of scope, if you like. You know, the acts and regulations are one thing, but if you have a different view of what you should be doing from your client or from your employer or your boss, that's the first part where things really get into trouble. Where it's not just a disagreement around what you're responsible for, but it's a lack of appreciation that there is a disagreement. So that I think is pretty important. But equally as important is making sure that the other functions have got very clearly defined scopes. What does the audit committee actually look at? What are they responsible for? What are they secretly relying on the actuary for? It's all fine and well to say the audit committee must be responsible for the reserves and solvency. If the first thing they do is look to the actual technician and say, well, so are we okay? Where does that responsibility lie? There may be compliance officers, there may be a market conduct or fair practice committee. All these entities, really we do need to be very clear on what they're responsible for and how they interact with one another. Clarity in reporting, and really this is about being clear what is covered and what is not covered. So again, in the actual report that we put together, this is what I've done, this is what I've found. By the way, these are things that I didn't look at. There's a danger there as well. What happens if you have looked at it and you are aware of an issue? Is it okay just to put down and say, well, I haven't looked at that, I'm not expressing a view on that? Again, maybe it's easy for me to say, not having a boss and having clients, I could in theory just say, well, if you don't like it, I'll walk away. Well, one never wants to walk away from clients. But I think it's really important to, at the very least, put down the factual information that you have at your fingertips. If you calculate that IBNR, and your best view of what that IBNR is 15% of premiums, I think that's absolutely critical. That is very clear in your report. That goes up to make you make people aware of what your analysis speaks to. And there's a chance you got it all wrong. There's a chance your data was wrong, so it's good to have the conversation. At the very least, make sure people are aware what those numbers look like. I think whether or not the committees and the board like it, I think you have a responsibility to make them aware of potential issues. And to a certain extent, this is kind of personal risk management. I made somebody aware of it. I made it their responsibility. But this was doing the right thing, making sure that the company had the information available, making sure there was no, well, 7% is fine, so that's what we're going to worry about. And if you're aware of issues that nobody is looking at, nobody worries about the fact that we're administering this business on a spreadsheet and everybody has access to it, and every now and again we delete rows by mistake. Yeah, and that's a very, I've seen one or two people laughing, but I've seen it at large insurers. But I mean, just being raising those issues, and again, sometimes it's going to be quite uncomfortable, quite awkward too. But I think on actuaries and associates and students, you have a responsibility to sometimes do the hard thing because it's the right thing. And the other fantastic thing about being an actuary, being an actual student, is you have a community. And professional support isn't professional help. I'm not saying you should go and see a psychologist. I think you should reach out to other people in the profession. You have an actual society in Zimbabwe, and I'm sure if you contacted David, he would either be able to give you some help or direct you someplace that could give you some help. Don't try to keep everything on your own shoulders. And a technical detail point here is that your financial reporting standards won't necessarily even be following the regulatory standards. You're still probably going to need to be looking at many of these items for other reasons. So that is the end of my slides. Hopefully I've raised issues and raised eyebrows, and I certainly don't have all the answers, and really hoping we'll have some questions and thoughts, either on microinsurance. I'm very happy to talk directly to microinsurance and the regulatory direction we've taken there, which you can potentially inform some parts of your own regulation development, or in fact, my own experiences trying to do the right thing, do professional things when life gets hard, or on any other element of the science. Thank you very much.
David, I've got a question for you. I'll just speak loudly. What parts of the world do you actually see microinsurance working well, and where they've actually got a good framework going and people are actually receiving good value for money and insurers are actually making good profit themselves?
Thanks, Ian. So the question, in case you didn't hear it, is what parts of the world does microinsurance work well, where the framework's working well, where the policy holders getting value for money. And maybe I'll start with the slightly difficult point around South Africa, where I think it's sometimes hard to see the value that policyholders get. I think you probably saw the presentation at our last seminar a few weeks back, looking at how you can understand from a utility perspective how even potentially a very low claim ratio could still sometimes be utility enhancing for a policyholder. And I think that's is interesting, it's worthwhile pursuing. What came out of that for me is that the people for whom a low claim ratio might still be good were poor, financially at risk. And I guess maybe I worry a little bit as well about the people who are poor and financially at risk, being the people you can convince yourself you're doing a good thing with a claim ratio of 20 or 30%. On the other hand, microinsurance in South Africa, or communal policies and assistance policies and the small policies do provide a useful role in mitigating financial stress on the death of someone within the family, particularly if the alternative is to go into debt. So I also don't want to tar the whole thing saying, like I said, all bad, but there are definitely challenges there. Microinsurance in other parts of the world is far more micro than it is in South Africa. In South Africa, 10,000 Rand is a fairly small policy, and the regulations are looking at a 50,000 or 100,000 Rand or $5,000-$10,000 policy, which are actually fairly large on many standards. So in other parts of Africa and in India, the really is on a much smaller scale. I'm actually not as familiar with the regulatory frameworks there as perhaps I should be. You've probably all heard the stories around, I think it's parts of East Africa, where crop insurance is effectively done via at the point of sale seeds. So rather than having to go and underwrite the crop areas to underwrite the producer policy, it's sold at point of sale with a bag of seeds, and oftentimes those end up being benefits paid out on weather conditions rather than the individual conditions on a particular farm, which again tries to reduce the wealth costs. I think South Africa is, as perhaps we tend to do, put a lot of regulations behind the framework, whereas many other countries, microinsurance is operating more informally, with more risk there perhaps, but also maybe more able to adapt to the market. I mentioned about the plans in South Africa for this to be a risk-only product, and to many people in South Africa say, well, that actually doesn't meet the needs. What people really want is they want some sort of savings element. They want to feel they are going to get some value back, rather than just being a pure death benefit. And so, with maybe a looser framework, you would be able to provide next level, yes.
Some comments and perhaps questions to make. The first one is to say that that you said microinsurance means different things in different parts of Africa, and particularly as compared to what it may mean in South Africa in terms of the premium size. But my issue is to say that can we apply the full actuarial regime on such products and still remain something left for those who are underwriting to make some profit? But secondly, do you actually believe that microinsurance can be sold in this way? Something that is sold together with a fundamental product?
So we had a fairly intense debate in South Africa around this relaxation of saying, for an insurance company, we won't have a statutory actuary signing off, we will have an actuarial technician who may not even be a fellow. That was quite a bold step. Now, a lot of people, frankly, fairly unhappy with that. And the drive behind was to desperately see what else we could do to keep the costs down to have some actuarial involvement rather than none, because I do feel that these sort of analytical tools and approach and appreciation of risk that we have are still really, really useful, even in the microinsurance space, shorter premium guarantees. But we're definitely trying to simplify it and make it as inexpensive as possible. I suppose the other angle there is that ultimately this comes about to scale. If you have a large microinsurer with a large policyholder base, you can then spread the costs of that actuarial work over many, many more policyholders, rather than having a smaller microinsurer where frankly it can be a prohibitive cost. Your second question in the report is around how microinsurance can be sold along with other more standard. Right, I won't move. Other standard products. So again, just purely from a regulatory perspective. Thanks on the floor there. I won't move. I won't walk around. So from a regulation perspective, in order to sell microinsurance products, you are going to have a separate microinsurance license, and all the products will be sold in that license on its own. It's not to say you aren't allowed to write small insurance policies in a traditional license, but you won't get the benefits of the simpler capital calculation, the simpler reserve calculation, the uncapped commissions and the reduced market conduct standards. Those are all the carrots that you get if you are prepared to write in a separate microinsurance license rather than a full license. So that's perhaps not really the answer to your question, but it's what I can say from a staffing perspective. See if you have any better luck.
I just wanted to ask, which is perhaps what Neil also alluded to. I've seen a number of presentations on microinsurance. I'm yet to see one who's actually saying that they're making money. Have you seen one who's actually making money, or is it because the top of scale and whatever? Some of them are pretty large, like some in East Africa, but they're still not making any money, quite frankly.
Yeah, I mean, I'm also very much aware of insurers struggling to make money on microinsurers. Some of the original microinsurers, which effectively came out of microfinance initiatives in India, were intended not to really be profit-making entities. I think there can be a certain discipline instilled by aiming for at least a moderate amount of profit. I am aware of a couple of individual companies who, as part of their business, have microinsurance areas, and they do seem to make money. So I wouldn't say there's no hope to make money, but there are definitely challenges in the business model. The other topic I've sometimes talked to is takaful, which is an Islamic alternative to insurance. Anyway, I see lots of presentations, hear lots of talk about it, but ultimately many of those takaful players also are struggling to make money in the Middle East. In Malaysia, where it is based in the entire market, they do make money. So these sort of alternative structures perhaps have a shorter history than more traditional insurance, where we go back, several hundred years and take a little time to work it out. But no, there are entities that do make money.
Are they connected to credit institutions as well? I think a lot of money is made, and I think that's where a lot of abuse actually happens, is the micro-lending side.
So in my answer, I was deliberately excluding South Africa. South African people make a lot of money out of what we would term microinsurance, but the point's valid. It's a much larger policy size than in many other parts of the world. But there is significant money made out of funeral insurance and assistance business in South Africa. So there are others outside of South Africa who are still making money. And the couple I'm thinking of aren't directly related to lenders.
Thanks, David. On the responsibilities of the actuary, it's always like the blurry what the actuary is really responsible for or not responsible for. To your knowledge, are there any sanctions that are set out where an actuary is reasonably expected to have done something and they didn't do it because they were not legally required to? And then how are such issues done?
I don't think I have all the answers. That's a general answer. I think I don't have all the answers. The Actuaries Code and compliance with 18106 and all that guidance notes if you are found not to have performed in accordance with those, you would be in front of an actuarial disciplinary committee, tribunal. So just because the regulations say that's not your job, I think the actual society does place a higher standard. I remember attending a session meeting many years ago now, where I think it was a lawyer talking, and his warning effectively was, be careful as an actual society what you put in your guidance, because you can actually then start making actuaries legally responsible and accountable and be at the wrong end of the lawsuit because you said you must do this, you must do this, you must do this. If your guidance notice becomes a wish list of everything you possibly hope for in an ideal world, you're actually going to end up having a lot of additional professional risk. So I think we don't want to end up there. Guidance notes, in my mind, do a couple of things. They provide guidance on how to do things. They increase standards to make sure that fewer people, as few people as possible, aren't doing the basic fundamentals. And it also provides massive protection to actuaries. That you can go to your employer and I can go to my client and say, I can't do that because guidance says I may not. I must do that because guidance says I have to. And without that there, it becomes a debate between you and me around what we think is right or wrong. So that, in many ways, is the value of a guidance note. But again, non-compliance with that, the actual society has a disciplinary processes. I don't know what the Zimbabwean actual society has, but you know, I'm also still a fellow in the UK, so there's a bunch of different people that hold me to account. So I better make sure I do the right thing.
I just want to follow up to that, to say, so is there, from your definition of microinsurance, it doesn't really talk about the size of it. So is there like a level beyond which you say, even though the individual policies tick the boxes of a microinsurance, but because now we have 2 million policies and the total premium book of songs, it is now graduated to
Maybe just to clear the maximum upper bound.
So in terms of, there's no limit on premiums. There is a limit on the sum assured per policy. So in theory, you could charge $1 million premium for a $10,000 sum assured. Yeah, so it is a maximum sum assured of $10,000. And what's interesting is that hopefully we would all feel that ideally that should really apply to a policy holder, but there are always practical difficulties in trying to track that down between different policy holders. The way the proposed regulation stands is $10,000 maximum per policy. So you could have multiple policies across different insurers, or multiple policies at the same insurer. Again, that's an area we feel is the scope for abuse, the scope for fraud, so definitely an area to watch out for. There's no maximum size specified either in regulations or in terms of guidance of when you be deemed to be something else. Gut feel, well actually, so one interesting point is the capital calculations give you a lower capital requirement than a full Solvency II standard calculation up until a certain size. And then the diversification benefit that you get from a more sophisticated actually says your capital will be lower than more sophisticated capital approach. So it might well be that naturally very large microinsurers in South Africa would elect to become SAM regulated with all the governance and risk requirements there and have a more complicated capital requirement. Which maybe is quite a neat answer, but no, it doesn't balance. I think it'd be quite hard for us as an actual society to say this is the absolute limit where you must start having a whole other set of responsibility come in. I think even for a very small insurer, one policyholder, if you are aware of problems, aware of solvency issues, I believe you do have, it would be irresponsible not to make people aware of them, not to inform processes. And I guess in the very extreme scenario, with nothing being done about it, the ongoing process of no mitigation, it's not that you need to resign. It really is that you don't want to get to a lot of people. I think we're probably about out of time. Is it what's the top one?
Can you just clarify, is it $10,000 US for $10,000?
So it is 100,000 rand, which I'm approximating as $10,000. Unfortunately, it's actually more like $8,000 now. It was much easier a year or so. Yes, no?
That last point, we want to do an actuaries aware of issues outside the scope. Does it seem like just raising the issue with the board is protection from a lawsuit? So are you supposed to document or report?
Okay, so I'm not a lawyer. You can't get legal advice from me whatsoever. But there's an acronym. I'm not sure if I'm allowed to say this. CYA. Have your ass. So yes, I think in that situation you want to do the right thing by letting them know, make sure you communicate, make sure it's minuted for yourself. An email back saying, whatever is probably a good, sensible thing to do. But hopefully the real issue here is make sure the board is aware of it rather than you've got yourself covered. But sure, you've got to worry about ourselves.
Just on that, so for a life insurer, the statutory actuary has whistleblowing responsibilities. Is that not the same for an actual technician and microinsurance? So for a life insurer, the statutory should be obliged to go to the FSB or the regulator if they felt, so if they've given advice and the board rejected it and said we don't care that there's all these issues, we're not going to do anything, you would then have to go to the FSB within 2 working weeks and report to them. Actual technician not.
So that's my understanding. We don't yet have actual legislation. What we've got is a directive from 2011 and then updating the insurance bill now that says that's mostly how it's going to work. So the details may still come through. But in fact, the only thing there that I think they would ever legislate would be if your recommendation on premium rates is disregarded. Because from a regulated perspective, that's all they're saying you're responsible for. So it'd be quite hard to say you're responsible only for premium rates, but if you see anything else, you must then whistleblower, whereas the statutory actual is different. You do have much wider responsibilities.
I think if you, as a member of Actuarial Society, according to the code of conduct, if you see funny business going on, you in any way oblige regardless of the role you're working in.
So the other leg of the whistleblowing requirements in the current Long-Term Insurance Act is that you may not be prosecuted for having done that. They have to give you that protection as well, because you will be taking confidential company information and doing something that they told you not to effectively. The tricky thing there is absolutely, that's what I say, don't ask for help. The point about seeking additional professional support is almost the most important one. I don't have all the answers. Giles has most of them. I call Giles and he'd tell me what to do. Or I call Neil and Neil will tell me what the actual society wants me to do. But there's a genuine risk to be careful of is in whistleblowing or telling something to a third party, outside party regulator. If it's not your responsibility, the specific conditions will matter. But I give the very small part of the professional course for new qualifying actuaries, and sometimes the answer is there's something probably going on, and it seems like the students want to say we'll go and tell the FBI and the CIA and everybody as the very first step. You may ultimately need to go to the regulator, but there are a range of steps and things you need to do before then to make sure you've got the right information, you've given the person a chance to work. But it's not saying never go to the regulator, that is what's required. Okay, thank you very much.